Hey guys, Damon from, well, you know who I am. If you're watching the video, you know who I am. Alright, so I'm going to be responding to a question that was asked from a student today on the phone, and during the course of answering his question, I realized that it would be easier simply to make a video and show it to more than just him because other people would stand to gain from this answer. The question is, how do I know when I am when I'm purchasing a call option or a put option, how do I know whether to go with in the money or out of the money? If you don't know, these two initialisms, ITM and OTM, are what we usually say because it's faster to say than in the money and out of the money. The meaning of these, well, let's do a quick review of the basics so nobody's confused. We're looking at Amazon. It's really expensive. It's $1,000 per share. I don't want to pay that much money, but let's say I want to take a long position on Amazon. What I'll do is I'll buy a long call option. Now, I'm not saying that's the best choice for trading Amazon in a long position, but let's just assume that's what I'm going to do. The question now is, do I buy with a low strike price or a high strike price? The strike price determines whether the option is profitable at the end of a certain time. So here are your times up at the top. They're called expiration dates. The strike price, in definition, gives you the right to buy the stock at that price. So if Amazon is trading at $99.4 right now and I have a call option of a strike price of $9.90, that means I have a profitable call option. I can sell that call option for $430. If I'm holding one of these, however, the call option is worthless on June 16, because why would I want to buy Amazon for $1,000 if it's trading on the stock market for $9.94? Right? If you need more info on the basics of options, look them up, pause the video, look them up, and then come back. I'm not going to get too in depth on the basics. We're to go and look at something that I consider to be more simple, which is determining which one to buy. Right, so what we've got is a layout. There are many more options. There are many more strike prices than the ones you see here, but I'm just narrowing it down to the closest 11. And by the way, we're looking at a monthly, not a weekly. I'll touch on that later, but for now, just know that for most explanations, I'm going to be using the monthlies because there are stocks, there are tickers that don't have weeklies. For example, in our newsletter, we recently played earnings on Burrow. That does not have any weeklies. You can only play the monthlies. So we're going to be dealing with the monthlies on Amazon just as an example. Alright. If it's in blue, it's in the money. If it's in black, it's out of the money. You can divide all of the strike prices up into whether it's in the money or out of the money and how far in the money it is. For example, this is in the money by $2, and this is out of the money by 70 cents. My definition for these two that are right next to the actual price of Amazon is at the money. I call these both at the money. So when I say I'm buying an in the money option, I'm buying something here or further upward. And out of the money, it would be here or further downward. Now, the main question is, which one's going to be better? It's not an easy question to answer, but there's an easy methodology for determining which one you want. Essentially, all you gotta do is imagine Amazon moving upward as you expect, as you want. as it moves upward, all of this blue area will start to shift downward. And whatever you bought, to see what the values will be, and all of these values are important. I'll explain them in a second. To see what the values will be, all you have to do is look upward by whatever dollar price Amazon is moving or expected to move. So let's say you buy the 990s and Amazon moves up $5. In that case, all of these values will become pretty much the same as all of these values. So the option that you bought for $1,900 is now probably going to be worth $2,180, and all of these other numbers will also be rather similar to what you see above. This is your methodology for predicting how the option will look after Amazon moves a certain extent. It also helps you look at what happens if Amazon moves against you. Let's say I buy these 990s and Amazon happens to move $10 downward, which is not what I wanted. Well, all I have to do is I have to just shift down $10. So I shift down to here. That's what it's going to look like. So the new price is probably going to be $1,350. The new delta is going to be 0.453. That gives you your idea. That gives you an idea of the future of the option. So you do the same thing with the out of the money. You'll see that the in the money and the out of the money change in different ways as Amazon moves. Now the question was, which one do I want? Do I like the changes both on the upside and the downside of the in the money option more than the out of the money option, or vice versa? And generally, the answer I gave is generally I will go with the in the money. And there's a couple reasons for that. So this is the point of the video. If I was forced to choose, all things being equal, a in the money option on Amazon or an out of the money option on Amazon on just a pure upward play, perhaps I believe that this momentum will continue upward. If that's what I'm going to do, I will probably go with the in the money. Reason one is there's less need to hedge this theta value. Theta is important because it tells you essentially how much money you're spending per day to hold that position, to keep that position open. For a lot of new option traders, the majority of losses in option trading at the beginning come from theta. Theta is the time decay of the option. An option is a contract with an expiration date. The expiration date is above, and of course we can change that, but we're going to hold that to be constant for now. As we approach the expiration date, the option, by definition, is less valuable because there's less potential for movement. Now, theta tells you what you're spending per day today, and it will change tomorrow. It will become larger tomorrow. If you want to see by how much it changes, then you're going to have to look at second order Greeks. We're not going to do that today. Just consider this to be, in general, the amount of money you're spending per day to keep this position open. And it also represents the amount of money you're going to lose if Amazon trends sideways. So there you can see the major downside with playing options versus stock. If stock moves up or sideways, you're good. If it moves down, you're bad. But for options, if stock moves any direction besides up, including sideways, you are going to lose money. And theta represents how much you're losing per day. Now, I said I like the in the money because there's less reason to hedge. And what I mean by that is the change in theta is going to be not so bad as Amazon moves upward. So if we're correct and Amazon is moving upward, theta is going to shrink. You can see this just by moving outward. If the 11 strikes don't give you a good idea, you just need to move out. You see how theta is getting smaller as we go upward? The further out you go, the smaller theta is. The less money you're spending per day to keep that position open. Now, obviously, if we are long and we're correct, that in the money, this 990 here, we'll see the theta value shrink. So you're paying less money per day to keep that open. That's advantage one. You don't see with that with the out of the money, because for the out of the money theta to shrink, it first has to get larger. For example, if we take this option and Amazon does move up and it moves past this value, you're going to see theta increasing before it ultimately decreases, like the in the money. The in the money gives us a head start on that theta decreasing. Now, an interesting note on theta is how to calculate what theta is reasonable for you. And if you find that theta is too big, what you could do is you can move out an expiration date or two, and you'll find that theta is smaller for these later expiration dates. But for now, where were we? But for now, what you can do to check whether your theta is reasonable or not, was this it? This was it. Is estimate how much you expect the stock to move upward per day. So here's what you do. Here's a quick equation. What you want to do is you want to find the value that Amazon needs to move per day so that you can break even versus the theta. So what you do is you first grab your delta. Let's say we're dealing with 990. Grab your delta. Delta is we always move decimals 2 spaces to the right so we can deal with the actual numbers. Delta is 55.1. Add an x, or multiply an x, and set that equal to your theta value. Theta is 0.365. We don't worry about the negative. And you just run that calculation. So 36.5 divided by 55.1 gives you your x value, which is 0.66. What does that mean? What that means is Amazon needs to move $0.66, in other words 66 cents per day, for you to make enough in upward profit to pay off that theta. So if your prediction is that Amazon's not going to be moving at least 30 or 66 cents per day, you need to choose a lower theta. So you have to go out to a further expiration date. Now, of course, that average is going to be based on your underlying thesis. So I'm not going to tell you how to find whatever your expected X is, but this at least gives you the calculation as to how much it needs to move for you to break even per day. Now let's say we're choosing the $1,000 strike. Let's make that calculation. Here, delta is 45 and theta is 37. So we're just going to change the numbers here. You can probably imagine what's going to happen. We got 37.5 divided by 55.1. So 68 is bigger than 66. In other words, if you buy the out of the money, you're going to have to see Amazon move faster than if you had bought the in the money. Your needed move is 68 cents per day versus 66 cents per day. Now, that difference might not seem large, but you got to realize theta is increasing every day. So, like if you're familiar with chaos mathematics, small perturbations at the very beginning of the calculation can, at the end of the calculation, lead to huge changes. So this is something you really got to think about. Can you accept a a faster decline in theta? If so, if theta is not such a big issue, then you can go with the out of the money. But for most just pure long trades, I would go with in the money. Now, what I said was I prefer the in the money because there's less need to hedge. There's a way you can get rid of theta, which is just called theta hedging, and I have other videos on how to do that. So if you are interested in that, check that out. But for now, we're just assuming that we're going with a very simple option trade because some people actually don't have access to more complex option trades. They can only buy calls or puts in their account. And for people of that sort, knowing which option to buy is a lot more important than for people who have access to lots of different types of option trades. So there's issue one. You have a less need. There, issue one. We'll say advantages. Here's why I buy ITM. I'll show you the advantages of OTM later. So ITM here, less need to hedge theta. That's number one. Number two, I don't know if I should put this down. Yeah, I will anyway. All right, I'll do it. Better spread choices. So like I said, we're just dealing with pure long options. So maybe this is not such a great reason, but if you want to hedge theta, it's easier to hedge theta when you're in the money. There are many examples as to why, and actually I should make a video dedicated to that. I'll give you the quick breakdown here. If you're going to be going with the out of the money, an out of the money option, let's say you buy the $1,000 one. If you want to hedge, one way of hedging is you you sell a more expensive call above that strike. So you might buy the $1,000 strike and then sell this one. Now on Amazon it's okay because the theta value is pretty fairly matched. But for things like Burl, which we looked at earlier, it's a lot harder to do on out of the money for a few reasons. One is you can see theta falls off really quickly. So if I were to buy the 105 and sell the 115, I'm not really hedging theta at all. I'm not really getting any benefit. This is called a spread, and the general set of benefits of the spread is you can hedge theta and you can get a lower price for the trade. You get the lower price because you buy the 105 while selling the 115. But as you can see here, last trade is representative of the amount of money you're going to pay for that option. You're only selling this for $5. It's nothing. But if you were to go with the long in the money, you have a lot more, many more choices. Here you can, for example, go long with a 90, and if you expect only a movement up to 105, for example, you could sell that one. Now, what you'd get is, look at that, theta for the 90 and the theta for the 105, they're the same. You would completely hedge theta because theta adds when you do a spread like this. So you'd have a theta of 0. You would not be spending money at all per day to hold this position open. So there you go. You've perfectly hedged theta with the in the money, but you couldn't do that if you started with an out of the money long call. In addition, like we said, the out of the money, if you were to hedge by selling a spread or by buying a spread through selling this 115, you only save $5. But if you were to do the 90 105, well, you save $50, which is considerably more. All right, let's not get too deep into spreads. Let's go back to Amazon. here is the third reason I would prefer to go with in the money over out of the money, and that is faster initial gains. Faster initial gains. Why? Let's say I'm right, and well, here's the thing. You want the initial gains to be fast. You want the initial gains to be part of the more important aspect of your play, because initial gains are easier to predict. What I mean by that is, let's say you are using a candlestick strategy to predict stock price movements, and you see, well, I don't see anything interesting here, but let's say this is a valid candlestick predictor, this pattern here, this 3 candlestick pattern. It predicts basically the next day. It doesn't predict 5 days in the future or 10 days in the future. So when you first enter a position, you generally have a much better idea of how the stock is going to move in the next day than in other durations of the future. So that first day of movement is generally pretty important. And if you are taking an in the money call option versus an out of the money call option, that first day of gains, those first more predictable, reliable gains, you're going to see them at a higher level. The way you know is through delta. Delta tells you how much money you expect to earn through the option for every $1 gain in the underlying. So if Amazon moves up $1 and we're holding this 990 strike call, we can expect to gain $55. But if we were holding the $1,000 call, we only made $45. And that's only going to get larger as Amazon moves up. As you can see, if we use that process I explained at the very beginning, you just move upward to see what's going to happen with your option in the future. Eventually, you're going to get to where it's almost 1. And when it's 1, the option is moving just like the stock. A $1 move in the stock equates to a $100 profit for anyone holding that option. So, I mean, there's the potential for both the out of the money and the in the money to hit 1 for delta, but it's going to be hit faster by the in the money. So I like those faster initial gains. I would rather make money strongly at the beginning, and then if things fizzle out at the end, it's fine because I've already realized the majority of my profits. That's one of the main drivers of going with in the money. Now, I would sum up my decision with these 3. I don't really need more reasons to go with in the money over out of the money, all things being equal. But there are some advantages to holding an out of the money call, and especially for a stock like Amazon that allows you to play on the weeklies. If we have weeklies available and a price target, I like out of the money. So out of the money, I prefer OTM to ITM if here are 2 conditions. One is we have a price target, and 2 is we can play weekly options. Alright, if we have those 2 conditions, I like out of the money. I'll explain why. As we go to the weeklies, which by the way are more liquid, they're easier to trade, they generally have tighter bid-ask spreads, which means that you're not going to be, well, the tighter the bid-ask spread, the easier it is to trade, and the more money you're going to save by slightly, like moving up in increments between the bid and ask when you initially buy and sell the option. And I made a video about that recently, so please check something related to what was it like how I enter orders or order entry of options, something like that. I explained my process, but that's one advantage, but it's not the main advantage. It's not the main reason I would like to go with out of the money with weeklies. The main reason is, all right, look, out of the money, it's always going to be cheaper to play out of the money. All right, here's your price. It's always going to be cheaper as you go out of the money. But the reduction of that price comes at a significant cost. And the essential reason for that cost reduction is there's a higher probability that whatever you paid for that option is going to be wasted. Your option is going to become worthless as you hit that expiration date. Because if the stock price is below your strike price, that option goes to zero. You lose everything you put in it. Now, obviously, that's more possible with an out-of-the-money option. But if you have a price target and also a general idea of when it's going to be hit, the weeklies out of the money are good buys, and they're really cheap. Remember, we're buying essentially $1,000 stock, but here, with these even weekly at the monies, we're only paying a couple $100. Compare that to the monthlies, you see a significant drop in price. The monthlies are going to cost us at least $1,500. And if I'm going within the money, I'm going to be paying almost $2,000 for these monthlies. But the out-of-the-money monthlies are just so cheap that they're worth it if you know your price target. And I use this a lot on out-of-the-money, on gap trades. Gaps that I expect to fill. For example, in my newsletter, we're playing price line. We're expecting this to fill. Down here, I bought price line. It's already up like 60%, this option I bought. So I bought it for actually it's doubled. I think I bought it for maybe $2,000 and now it's $4,000, and that was an out of the money option. So I set it out of the money, and I did the same thing with FedEx, and within a couple days I saw doubling of like a double ROI of 100%. So I doubled my investment. Same thing. This was a gap play. If you're interested in gap plays, check out my website, the Gap Game Plan. You will be able to see how I play these area gaps. But once I see these gaps, I will generally buy, if I'm just taking a long option position, I'll generally buy the out of the money. And if they have weeklies, I'll buy the out of the money weeklies. Because I have a price target, for example, right here. Let's say I saw the gap on May 18, which I think is actually the case for this one. And I wanted to take a long position so that when this gap fills, I'll be able to sell my option, and the gap fills at 194. So my price target's 194. And at the time of purchase, FedEx was at 190. So I know I can buy out of the money that is going to be between where we're at and between where the gap closes. That's probably going to be my best bet. I can close the option slightly in the money. But I wouldn't do that if I didn't have a price target. If I, for example, on Amazon's a good example. If I don't know how far Amazon's going to move upward, I probably won't go out of the money. I'd rather go within the money because I want those initial gains, and I don't want to have to hedge theta if I'm going to be holding for a long time. Now, again, taking a look, all you have to do to imagine what's going to happen with these weeklies out of the money is look up. So if Amazon moves upward $5 and we're playing these $1,000 out of the money on the weekly options, which is, you're going to see it's a big difference from the monthlies that we just looked at. We looked at the 1,000 monthlies. Now we're looking at the 1,000 weeklies. We're only spending like $200 on this, right? And we got really high volume, but also upward is high volume. So even if it goes very far in the money, because it's the weeklies, pretty much everything has volume. Weeklies are really easy to trade. They're really easy to close. I've traded options on less liquid stocks before and had trouble closing my positions because there's simply not enough volume. Not on the options in general, but not enough volume after I found my option to be highly profitable. In other words, highly in the money. The more in the money it goes, the harder it is to sell. But weeklies allow you to, well, weeklies essentially alleviate that problem. So that's reason number one, lower premium. I'm going to be paying significantly less on the out-of-the-money weeklies. Out-of-the-money weeklies are the cheapest options you can buy. They're great for someone who just wants to experiment with options. They're also great for someone who wants to get into options trading but doesn't have a lot of money. This is what I would recommend. Find a stock with a price target and go with the out-of-the-money weeklies. Now, the the bid-ask spread here is going to be lower as well, and in many cases you can just enter your order with a market order. Now, the most important thing is if you go with the out-of-the-money weeklies, you're going to find that your overall ROI is higher. So the result here, well, the benefits of OTM are simply lower price, higher ROI if successful. So it seems weird because a lot of people think that if you buy an in the money that's really expensive, you're going to have a high ROI when the trade is complete. But it's actually the out of the money that have higher ROIs. And it's easy to see that. All you have to do is look at the price. So we're paying, let's say, $200, like $180 for this. And look at the delta versus that price. This is, remember, delta shows you how much you're gaining when Amazon moves up $1. Now, one way to think about that is delta is the amount of, the number of shares you buy, the number of shares you're mimicking holding when you buy this call option. So here for $180, we get exposure to 28 shares. Let's check out that ratio. So we've got, what was it, 28? Is that right? Yeah, 28 delta on $180. That is for our OTM. Now let's look at an equivalent ITM, and we're not even going to go to monthlies. We're just going to compare with the weeklies, but the monthlies are going to be even lower. So we'll do both. ITM weekly and then ITM monthly. So let's make that calculation real quick. Let's say we go with the 990s. These are the weekly. We get a delta of 63, price of, we'll say 600. And then for the original one we looked at, the in the money monthly, 990, and we're getting a delta of 55, and our price is 1900. And you could probably already see that this ratio is going to be the highest. 28 divided by 180. So you're essentially paying, you're essentially getting 15 shares or 16 shares of Amazon for every dollar you pay. That's the power of this one. What you mimic through the in the money weekly is getting about 10 shares per dollar, and what you mimic through the in the money monthly is getting about 3 shares per dollar. So profitability clearly I mean, profitability, how do you calculate it? You calculate it with your whatever you made divided by whatever you invested. That's going to be higher on this simply because you're investing so little, but you're getting so much power. You're getting the ability to mimic holding 13 shares of a $1,000 per share stock, and compared to all options are good. All of these are good in respect to actually buying the stock in terms of ROI, but this is going to be your best. It's only going to be profitable, however, if it actually goes in the money, or if it's getting to in the money before the expiration date. So you basically got a week for your prophecy to come true. If it does, it's immense profits. $1 for 13 shares, while your buddy paid $1,000 for one share. Think of it that way. I think that's answered pretty much everything I wanted to answer. My voice is going out. Let's take a quick look at Rho, because it's on there. I figure we should talk about it. Oh, Gamma is on here too. Gamma tells you the rate at which delta changes, but as you can see here, Gamma doesn't change that much, no matter whether you're in or out of the money. Rho changes quite a bit. The more in the money you go, the higher Rho goes. But the majority of investors aren't going to be even caring about Rho. They will probably be affected by Rho, but they won't care about it that much. What Rho is, Rho represents, like delta or theta, it represents a cash value attached to that option. And the way you use it is, if you're predicting changes in the interest rates, Rho tells you how much the option is going to gain if the interest rate is moved up 1%. So, if you're not predicting interest rate changes, it's kind of useless. But if you are, and you probably should be, because interest rates are going to be going up, you could actually do something few option traders ever do, which is you can trade the interest rate predictions. So if you think interest rates are not rising while all the other traders are thinking they are going to rise, they're paying to gain exposure to Rho. What you could do is you could short Rho. That's just a little idea there. Anyway, I think I've answered pretty much everything that needs to be answered. Again, the question has an answer that's more of a rule of thumb than a correct answer. There is no correct answer. The more you trade options, the more familiar you'll become with all the choices that are available to you, and the more you'll realize that you have a preference for one over the other. People who don't have a high risk tolerance probably won't go with these out of the money weekly. They'll probably like the in the monies a lot more. I like the in the monies more because I worry about theta and because I care about the initial gains more than the end gains. But everybody has his own trading style, and as you go through life, as you have a family and children, or you lose family and children, your risk tolerance is going to change, and you're going to find yourself preferring things that you didn't previously prefer. But to sum up my rules of thumb, if you don't have a price target and you don't have weekly options on the stock, go within the money. If you are playing something like a area gap, like in FedEx or Priceline, and you're expecting it to fill, you have a clear price target. You're expecting it to hit the low point of this candlestick before the gap. Here for Priceline, it hasn't filled yet. For Priceline, the low here is 1898, and we haven't yet hit that. I would put, like for this one, actually I remember this one, I put my strike price at 1840. So I bought it probably around here, or maybe here, I don't know. Bought it around here, let's say I bought it here. So that's at 18. I figured it's to close at 18.90. So I put my strike price about halfway between. That's how I chose my strike. Now, in general, this is something I didn't address, but in general, if I am choosing an in the money, my strike is going to be whatever I think is reasonable based on the price of the option. So I'm going to look at the last trade primarily. If I know I want to be in the money, I'll start with this one, and then I'll look upward and I'll ask myself, am I willing to spend more on this trade? And if I were willing to spend, for example, 3,600, what I would do is simply buy 2 of these instead of buying these, because the volume's too low. The open interest isn't, the volume's too low. So there's going to be a range in here for in the money. I'd be willing to buy from here to perhaps here, and anything above it I would pass on, and instead I'd just buy 2 or 3 of these. So there you go. In the money, there's your benefits. Out of the money, makes a lot of sense if you got weekly and a price target, and you're going to end up with higher ROIs. Whenever you see those impressive ROIs that I show off once in a while, I'm generally showing them off on out of the money trades. I have a lot of more reasonable ROIs with my in the money, but they're a lot more boring to look at. That's it. If you have any questions, remember this video was created because of a question. Please leave your questions in the comments below, and if it's a good question, I'll make a video, because I figure to help more than just you. If I can help 2 or more people with a video, I'll do it. That's it. And again, if you're interested in matching what we learned today with an actual strategy like gap trading, go ahead and check out my website, damonverio.com, and you're gonna see. Well, actually, what you could do is the gap method. I figure you probably want something free first, right? If you type in the gap method in Google, you'll get this page. Put your email address there, and I'll give you a free guide. And then if you want to one day upgrade to buying my course, The Gap Game Plan, you can do so. That'll show you how to do these nice gap trades. All right, that's it. Take care. Love you guys.